Trying to predict where Bitcoin will be in 2 years feels a bit like trying to read tea leaves in the middle of a hurricane, but it's a question on every investor's mind. When I look at the landscape for 2026, I see a fascinating clash between the raw sentiment of the crowd and the polished forecasts of institutional analysts, leaving many of us wondering which path Bitcoin will actually take. The conversations I'm having and the data I'm seeing paint a picture full of contradictions, and frankly, that's not surprising for an asset that has always defied easy categorization. What's really at stake is whether Bitcoin matures into a more predictable asset, or if its wild, volatile nature is here to stay, especially as big money continues to pour in. When you look at prediction markets, which are often seen as an unfiltered gauge of collective belief, the outlook for Bitcoin hitting spectacular new highs seems to be cooling down significantly. Polymarket, a decentralized platform where users bet on future events, currently shows only a 27% probability that Bitcoin will reach the $150,000 mark by the end of 2026. This is a pretty sobering statistic, especially when you consider the bullish fervor that often surrounds crypto price targets. To me, this suggests that the everyday trader, the person putting their own money on the line in these markets, is becoming more pragmatic and perhaps more cautious. They aren't necessarily bearish, but they are tempering their expectations. The data from Polymarket gets even more interesting when you dig into the specifics. While 36% of bettors on that particular market do believe the $150,000 target is achievable by December 2026, a much larger majority remains skeptical. In fact, a significant 61% of participants are betting that Bitcoin will fail to even break the symbolic $100,000 barrier in 2026. This sentiment is unforming in a vacuum. It's being shaped by the market's recent behavior. We've all seen the simulations and projections suggesting a wild ride, with some models pointing to a potential peak near $126,000 in late 2025, only to be followed by a sharp correction that could pull the price back below $90,000 by the year's end. This kind of whiplash price action highlights just how sensitive Bitcoin has become to broader macroeconomic shifts, a trend that's only intensifying. Yet, in the face of this crowdsourced skepticism, the old guard of financial analysis remains steadfastly optimistic. The single biggest factor that will define Bitcoin's journey to 2026 is, without a doubt, the continued influence of institutional money, particularly through Bitcoin ETFs. These exchange-traded funds have fundamentally altered the market's DNA. When they were launched, they were hailed as the key to unlocking massive mainstream adoption, and in many ways, they have delivered. Major financial players are now in the game, bringing with them trillions of dollars in potential capital. However, this has come at a cost. As Jeff Kendrick, a sharp analyst at Standard Chartered, has pointed out, these ETFs have tethered Bitcoin more tightly to the traditional financial world. Its price is now more reactive to macroeconomic data like interest rate decisions from the Fed or monthly inflation reports. We got a taste of this new reality in 2025, when a 30% drop from the October peak was largely attributed to shifts in the macroeconomic outlook, showcasing the new risks that come with this institutional embrace. This new dynamic also changes the role of other market players. For years, the market found a degree of support from digital asset treasuries, which were essentially crypto-native funds and companies holding large amounts of Bitcoin. Their influence seems to be on the decline as the sheer scale of ETF flows begins to dwarf them. The ETFs are now the primary drivers of demand. In a bull market, this can be incredibly powerful, creating a stable floor of buying pressure as they attract consistent long-term capital. However, the flip side is equally true. In a panic, massive outflows from these ETFs could amplify volatility to a degree we haven't seen before, triggering cascading sell-offs. This makes 2026 a critical transition period. Bitcoin has to prove that it can withstand the pressures of being a mainstream financial asset, absorbing the shocks of massive capital flows in both directions. For me as an investor, this means the old playbook of just acculent through volatility might need an update. It now requires a heightened sense of vigilance and a more sophisticated approach to risk management, one that accounts for an environment that is far more interconnected and uncertain than ever before. So, who should you believe when it comes to Bitcoin's price in 2026? The truth is, the predictions are more polarized than I can ever remember. On one side, you have the institutional powerhouses like Bernstein and Grayscale, who are sticking to their guns with impressive price targets of $150,000, $200,000, or even higher.
Nice.
Their bullish thesis is built on a few core pillars that are hard to ignore. First, the growing adoption of ETFs is a real and powerful force, continuously siphoning capital from the traditional world into the digital one. Second, Bitcoin's programmed scarcity, the hard cap of 21 million coins, remains its most compelling fundamental attribute, a feature that becomes more potent as demand grows. Finally, they point to Bitcoin's historical 4-year cycles, which have consistently shown that a major rebound and new all-time high tend to follow each significant correction and halving event. From their perspective, the current market is simply following a well-trodden path toward higher valuations. However, on the complete opposite end of the spectrum, you have analytical models, like those based on Elliott wave theory, that are painting a very different, much more bearish picture for 2026. These models suggest that the current rally might be the final wave of a larger cycle, and that a prolonged bear market could be just around the corner. This theory posits that market psychology moves in predictable patterns of optimism and pessimism, and we may be approaching a peak of optimism that will inevitably give way to a major downturn. Faced with such a deep and fundamental disagreement among experts, what's a regular investor supposed to do? There's no single right answer. Some of my peers are doubling down on diversification, spreading their capital across different asset classes to insulate themselves from crypto-specific volatility. Others are becoming more tactical, relying on technical indicators like the super trend or moving averages to help them navigate the short-term noise and make more informed entry and exit decisions. The one thing everyone seems to agree on is that 2026 will be a year that demands our full attention. In this environment, arming yourself with quality information and exercising a healthy dose of prudence will be your most valuable assets. Ultimately, the debate over Bitcoin's future in 2026 is a fascinating microcosm of the asset's identity crisis. It's caught between the skeptical pragmatism of the Polymarket bettors and the ambitious, long-term vision of powerful financial institutions. The experts, meanwhile, are forecasting everything from a historic bull run to a devastating collapse. As we move forward in this increasingly volatile and interconnected market, every investor is left with a fundamental question that goes beyond just price charts and analyst reports. Do you follow the momentum of the crowd and the emerging trends, or do you anchor your strategy to the underlying fundamentals that made Bitcoin so compelling in the first place? My personal approach has always been to find a balance, but I'll admit finding that equilibrium is getting harder every day.